It's Wednesday, February 4th, 2026. What you're watching right now in precious metals is not a bounce. It's not a dead cat rally. It's a warning flare. In the last 48 hours, gold has staged an absolutely violent recovery, up more than 15% off the Monday lows. Silver has ripped even harder, up more than 25% off the lows. Trillions of dollars of market value have snapped back in just 2 days. The kind of reversal that usually only happens when a forced liquidation ends and something bigger is pulling prices higher. But here's the part most people are missing. This isn't just about price, it's about access. Because while the screens are turning green again, the physical metal, especially silver, is disappearing from the system at speed. And when physical drains while paper rallies, you're looking at a market where the real story is happening behind the quotes. Paper price can recover in a day. Physical supply cannot. And right now, physical supply is getting tighter, not looser. If you've been around markets long enough, you know what a forced unwind looks like. You get margin calls, you get liquidations, you get the sell everything moment where good assets and bad assets get dumped together. Metals get hit with the rest of the tape. Then, after leverage is flushed out, the asset that has real structural demand snaps back first. That's exactly what this recovery looks like. But the real signal isn't the percentage bounce. The real signal is what happened inside the plumbing of the metals market while everyone was watching the price candles. Silver is leaving vaults, not slowly and not quietly. And it matters because silver is not just an investment metal. It's an industrial metal that gets consumed. Once it's in solar panels, circuit boards, medical devices, sensors, and batteries, good luck getting it back. This is not gold, where nearly everything ever mined still exists in bars, coins, and jewelry. Silver is used up. So when you see large vault withdrawals, you're not just looking at a number on a report. You're looking at metal moving into hands that don't plan to flip it back into the market. That's the difference between a market that's speculative and a market that's entering a supply stress phase. Now let's connect this to the second signal, China. Because while the West watches charts, China watches access. And what's been happening in China over the last couple days should make every investor stop and pay attention. When gold dipped, retail demand surged hard enough that people reported problems accessing bank apps to buy gold-linked products and physical allocations through major banks. That is not something you ignore. Think about how powerful that is. A dip creates a buying rush so intense that systems get overloaded. People get locked out of buying the safe asset at the exact moment they want it. That's not a glitch. That's a signal. It tells you demand is not theoretical. It's urgent, emotional, and moving through the largest population base on Earth with a deep cultural instinct for hard assets when trust in institutions gets shaky. And it gets even more important when you understand the global spread of that demand. If the paper price says one thing, but premiums in different regions tell another story, the market is telling you where the tightness lives. When buyers in Asia or the Middle East are paying above the Western spot price, that's not superstition. That's a real-time measure of scarcity, logistics, and immediate delivery demand. So here's the key point. This recovery is happening at the same time physical is leaving the system. That's not normal. Normal is price rises and metal flows back into inventories as holders take profits. What we're seeing instead is price rises and inventories still drain. That should make you uncomfortable if you're short and if you're long. Now let's widen the lens, because the geopolitical calendar is adding fuel to this entire setup. The United States has moved silver into a different category mentally, away from just a precious metal and towards strategic material. And when governments start treating materials as strategic, markets change. Strategic materials are about securing supply, not optimizing price. If you build stockpiles, you're acting like a buyer of last resort. You're saying you want access no matter the inconvenience. That's the mindset of defense supply chains and national security planning. And once that mindset takes over, you're not just dealing with investors anymore, you're dealing with policy. Here's why that matters for silver in particular. Silver sits at the intersection of electrification, solar, chips, advanced electronics, medical technology, and defense systems. Even modest policy shifts can pull real metal out of the market, because supply planners don't want to be exposed to shortages. The next layer is China's control of processing and refined material flows across key minerals. The West can talk about diversifying supply, but refining capacity is the choke point. Processing is where the leverage is. As long as the world runs through that choke point, strategic planning doesn't reduce scarcity. It often accelerates hoarding. So when you see policy events, ministerials, stockpile announcements, and critical mineral language, don't treat it like political theater. Treat it like demand because it becomes demand. Now let's talk about what's happening in the futures market because this is where a lot of people get it backwards. When open interest collapses after a crash, it often means the forced liquidation phase is completing. The hot money leaves and the weak hands are gone. The market becomes less crowded. And when a market becomes less crowded, it becomes easier for a real supply squeeze to express itself because there are fewer paper players absorbing pressure. If physical buyers are the ones stepping in, the pricing mechanism gets stressed. What you want to watch is whether the paper market is being abandoned while physical demand remains strong. If that's what's happening, it sets up a powerful dynamic. Less paper leverage, more physical accumulation, tighter inventories, higher volatility. And that volatility cuts both ways. Silver doesn't move like gold. Silver is savage. It will punish you emotionally before it rewards you financially. If you can't tolerate violent drawdowns, silver will shake you out at the worst possible time. That's not opinion, that's history. But history also shows something else. The most explosive upside in silver tends to happen after the market has been flushed, after speculators are forced out and physical tightness is still there. That's why these vault flows matter so much. It's the difference between a chart story and a supply story. Now, before we go any further, I want to be extremely clear. This is not financial advice. Markets can stay irrational longer than anyone can stay comfortable. Volatility can wreck you. If you're trading on leverage, you're playing with fire. What I'm doing here is connecting signals. And the signals right now are not normal conditions. You've got a massive two-day rebound, but at the same time, signs of tightness are showing up where they matter most. Inventories, premiums, and access. That's the setup. Now let's add one more factor that can change everything. Stress in sovereign bond markets can shift the entire picture. When major bond markets show weakness, whether it's Japan, the US, or anywhere systemically important, you can get sudden global risk-off waves. In those moments, everything sells first. Stocks sell, crypto sells, metals can sell too, even if the fundamentals are bullish. Then the second wave comes. The second wave is where capital tries to find safety again. Historically, that's when gold's role becomes more obvious and recovers faster than most assets. So if you're wondering why metals can crash and recover violently, this is why. You're watching two markets at once, the liquidity market and the fundamentals market. The liquidity market is short-term and brutal. The fundamentals market is slow until it isn't. Now here's the most important thing to carry forward from today. If you want to understand where this goes next, stop obsessing over headlines and start tracking access. Access is the tell. When people can't buy when they want to buy, pay attention. When premiums widen, when physical drains despite rising prices, when inventories fall across multiple regions at the same time, that's when you're no longer dealing with a normal trade. You're dealing with a supply event building under the surface. Supply events don't announce themselves with a press release. They show up as friction. Friction in settlement, friction in vault flows, friction in premiums, friction in availability. This is why the most important sentence in this entire update is simple. Physical disappears first. Price adjusts later. That's how it works and how it has always worked. And if that's the phase we're entering, then the last crash wasn't the end of the story. It was the cleansing. It removed leverage, shook out weak hands, and created a window for accumulation. Now the market is rebounding into a tighter physical environment than it had before the crash. That is not bearish. That is combustible. So what should you watch from here? Watch inventories. Watch premiums. Watch delivery stress. Watch whether vault drains continue even as prices rise. Watch whether retail demand surges on dips and strains access again. Watch whether policy headlines translate into real procurement and stockpiling behavior. Watch whether bond market stress creates another wave of forced selling and whether metals recover again even faster afterward. Because if you see repeated cycles of sell-off, physical drain, and fast rebound, you're watching the paper market lose control of the narrative. And that's when markets stop moving smoothly and start moving violently. One final thought. Most people look at a crash and assume it means the thesis is dead. Professionals look at a crash and ask a different question. Did anything fundamental change? If inventories are still draining, if industrial demand is still rising, if governments are still treating supply as strategic, if buyers are still paying premiums, if access is still tightening, then the fundamentals didn't break. The leverage did. And when leverage breaks, it hurts. Then it resets the board. That's where we are now. The recovery is real. The volatility isn't over. And the physical market is sending signals you shouldn't ignore. Watch access, not headlines. And remember, if you can't take delivery, you don't truly control the asset. Someone else does. Stay sharp. Stay disciplined. And don't let the screen trick you into ignoring what the supply chain is shouting. OG out.